Good morning. Thank God it's Friday. Welcome to today's episode of Morning Wealth. I'm going to keep it very light today. Three things that we're going to talk about is US jobless claims, Fed's restriction on dividend payments, and BOE exploring negative rate setup. US stocks fell and treasuries gained. On Thursdays, investors mulled whether the levels of stimulus being provided is enough amid a gradual economic recovery. The Euro Stoxx 600 also fell by 0.5%. The Bloomberg Dollar Spot Index was also down by about 0.3%. The British Pound was little changed. The Euro was higher by 0.3% to 1.1847. Oil was higher. Oil climbed after Saudi Arabia expressed its determination to stop OPEC Plus members exceeding their output quotas. Gold fell 0.6% to about 1948 an ounce. In data released before the opening bell, filings for jobless benefits came in at about 860 last week. This is according to the Labour Department. The measure has shown stabilization at just below 900,000 in the recent weeks. Layoffs remain elevated though, despite some signs of broader labour market recovery. Stocks opened broadly lower at the open, rebounded slightly in late morning trading, and then resumed their downward slide in the afternoon. Energy and health sectors were the worst performers for the S&P 500, with materials and industrials the strongest. Further weighing on the trading were comments on Wednesday from Fed Chair Jerome Powell, who said that the economic outlook is highly uncertain. Policymakers indicated concern that easy gains from reopening the economy could mask deeper scars among the most vulnerable businesses, with people likely to face longer spells of joblessness. The central bank also signaled that the interest rates would stay near zero until 2023. This was an interesting comment from James Athey, who is a senior investment manager at Aberdeen. The Fed said it would keep rates low for ages, but that's not enough. Not taking away is no longer sufficient for this market. You just need to do more and more and more. So the cautious outlook from Fed and the fact that we have not got anything from Congress with respect to fiscal support is playing into the market at this point of time. Keeping with the Fed, the central bank is considering extending the unprecedented constraints on dividend payments and share buybacks that it imposed on the biggest US banks. Officials will decide in the next 2 weeks whether to prolong the limits, which are scheduled to lapse at the end of the third quarter. The announcement came as Fed started its second round of stress tests. The BOE kept its policy options open. The BOE will set up talks on negative rates. Policymakers held the key rate and QE target, but said they'll hold structured engagement with the Prudential Regulation Authority on how sub-zero rates can be implemented in the UK as the UK enters a period of unusual uncertainty. Bloomberg Economics' base case is for BOE to keep rates positive and ease once more with a further £100 billion of asset purchases in November. But it's becoming increasingly likely that if the economy is blown off course next year, the central bank could employ sub-zero rates. On the FX side, 24 hours after the Federal Reserve pledged to keep interest rates at zero until 2023, the US dollar extended its losses against all of the major currencies. The greenback fell the most against the euro and the New Zealand dollar and was the most resilient versus the Aussie and sterling. The day started with little consistency for the greenback, but by the end of the New York session, despite the losses that we saw in stocks, which is generally dollar positive, it was clear that Fed's dovish outlook made the dollar less attractive. The latest US economic reports were mostly weaker than expected. Housing starts and building permits declined in the month of August, while Philadelphia's Fed index failed to show improvement like the Empire State Survey. So that's the update. Stay safe and healthy. Have a lovely weekend, and I'll speak soon. Thank you.